Sagely investors, welcome back to the channel. My name is Crass, and in this video guys, I want to do a very interesting comparison between, on the one hand, a REIT called VAP, and on the other hand, residential property as an investment. So let's jump right into the spreadsheet. And by the way guys, I think this is going to be a very interesting and very thought-provoking video for you. So please leave a thumbs up if you enjoy this type of content. Now, for those of you who don't know VAP, it's basically Vanguard Australian Property. You can look it up either on marketindex.com.au under the ticker VAP, or you can basically go on the Vanguard website and learn more about it. But basically guys, as you can see in the spreadsheet here, we have a list of dividends that VAP has paid over the last 10 years, starting in 2011, right up until the most recent dividend in July 2021. 10 years ago, the price of VAP was $45 a share, and today's price is roughly $90 a share. So we can say that on average, it has appreciated by about 100% every decade. And on average, the dividends paid is about $3.63 per year. Now guys, this is an important time to say that none of this is financial advice. This is purely me being curious about what's a better investment. A broad, diversified commercial property REIT, or investing in residential property here in Sydney. So let's jump to the investment property tab. What I've done here guys is I've basically taken the average property in Sydney, and today's average property price is $1.1 million Australian in 2021. All links to my information are provided in the spreadsheet, highlighted in yellow, as you guys can see. So we've established that the average property in Sydney is $1.1 million. Now the average yield, the rental yield on a property in Sydney is about, according to this website, SQM Research, it's about 2.3%. I'm going to be generous. I'm going to say it's about 3% per year. That's based on the total property value. Now, let's take a look at this graph down here, which shows the average Sydney property price appreciation over the last 30 years. And on average, your property will appreciate by about 70% every decade. So going back to the Vanguard, we get an appreciation of about 100% over every decade by comparison. So taking all of this information into account, okay, let's consider the situation where you have a 20% deposit in cash available for that $1.1 million property. So you've got $220,000 available. And so you decide to go and buy this average property, and you will then borrow $880,000 from the bank. Now, the question is, what if you don't buy that property? And what if instead you decide to take that $220,000 and invest it in Vanguard VAP? What results are you going to get after 10 years, 20 years, and 30 years? Let's find out. So as you guys might have already surmised by these tables that you can see over here, I've split up the outcomes based on property and VAP over 10, 20, and 30 years. So to very quickly explain the table, you start off with a loan of $880,000, and after 10 years you end up with no loan. You've collected $220,000 in rent, you've paid $147,000 in interest, and your property value should be worth about 70% more, as you can see, $1.86 million after 10 years. Now, if we take all of those bits of information together and we crunch the profit here, you'll end up with about $173,000 worth of profit. And this is just a little side note here for me. You would have basically been paying off about $88,000 per year of that principal. So the same goes for year 20, year 30, okay? Same calculation. Now, for VAP, what happens if instead of buying an investment property, you say, hey, I'd rather buy a fully diversified commercial real estate. Let's see what the results are. So initially today, you invest $220,000. After 10 years, you would have collected $258,000 worth of dividends. you would have taken the interest that you would have paid for the property and you would have reinvested that over those years, as well as the principal that you would have paid for that property, and you would have also reinvested that into more VAP shares. Now, at the end of 10 years, you will end up with $1.6 million worth of VAP shares, and for a profit of $640,000. So if we scroll to the right here, guys, we can see my calculations behind this green table over a 10-year period, over a 20-year period, and over a 30-year period. Now, the amount that I'm actually investing every single year, let's start off with a 10-year period, is basically 1/10 of the interest and the principal getting invested back into the shares. And as you guys can see, the growth factor that I've used of about 6.5% results in roughly the same appreciation every decade as you would expect from the property, and it's a little bit less than 100% that I mentioned before. So this calculation is pretty conservative. Now, going back to the table, guys, you can see that you're going to make significant amounts of profit over 10 years, 20 years, and 30 years. And if you quickly contrast that against the profit that you expect to make from a residential investment property, you can very quickly see that VAP outperforms residential property every single year. Now, the other assumption that I've made behind this calculation is that your rent collected will not grow over time. And I think that's fair because I've made the same assumption that the number of dividends will not grow over time. Now, let's go to the summary, and to summarize everything, guys, you can basically see that whether you analyze this over a 10-year, 20-year, or a 30-year period, Vanguard VAP outperforms residential property by about $500,000. And keep in mind that I'm not reinvesting dividends. I have not had any growth in dividends. There's no growth in rent. There's no debt involved with VAP, and you get full diversification with VAP. So guys, to really summarize this video, really have a think about whether, if you have a large amount of money and you want to buy a very expensive property that costs above $1 million, whether that's the right decision. Because when you look at these results, they really should make you pause and think and ask the question, wait a minute, I'm spending all this money, I'm getting into debt to buy one property, while I can get better returns under a different investment scheme where I'm not getting into any sort of debt, and I'm getting full diversification of many properties. So I hope this has given you guys something to think about. Leave a thumbs up on the video if you enjoyed it, and I'll catch you guys in the next video.